Welcome to Coffee Can Investing and to our interview with Manish Gunwani, CIO of Equity Assets at Reliance Mutual Fund. Manish, welcome to the program. Great to have you here.
Thanks for having me.
So yours is a very interesting career because you're one of the few people who graduated from the IITs and IIMs in the mid 90s when the IIT boom was almost in full throttle, right? And in spite of graduating from the premier institutions during the IT boom, you chose not to go into that industry, not to go into management consulting. Instead, you chose the financial services industry. Would you talk us through that period, the initial period of your career, and why you entered the world of finance?
Yeah, so actually it goes back to my family, in fact.
I see.
So we were growing up in Hyderabad, and my father is a doctor.
I see.
So when I was in IIT during one of those long summers, I was just looking at some of the shares he's bought. So he being a doctor, now when in 1977, around that time, all these MNCs were asked to go public. So he was given free share of Glaxo.
Wow.
And I think he paid about, at a nominal price,
Right.
about 170 rupees he
Right.
paid. And when I was looking at it somewhere around 92, 93, it was worth 3-4 lakh rupees. Right? I mean, so for me, it was a kind of bulb going out. Ki, it's that easy to make money. So since then, in fact, I was one of the few guys who, in one of the summers, actually went and did a course in stock market while I was in IIT doing engineering. Much before I am. Because it just intrigued me that making money is so easy.
Right.
So since then, actually, engineering was dead for me. So it was always about finance. So
Right.
I was lucky enough to go to IIM and do a finance course. There too, I mean, from the first day, it was more about going into investments than anything else. So yeah, I, to that extent, I've been lucky that whatever I've wanted to do, I ended up doing it right after campus.
And from what I can understand, during your stints in brokerages through the 90s, early noughties, you also did a startup.
Yeah.
Where did that impulse come from?
So it's the cycle that gets you, right? So when I started off in research, I happened to be in that bubble sector of the late 90s, which is software services. Okay. And I was covering all the tech sectors, tech companies, and it again looked so easy to make money, right? I mean, just do something and export to US.
Right.
And then a couple of my IIT batchmates had started this company in Hyderabad again, which already had some contracts from US. So I just thought that let's join and create another Infosys, whatever. So it looked very easy to do that.
So you quit your job in broking in Bombay, went to Hyderabad to do a startup.
And then when we started doing that business, then we realized that we are probably the 700th NASCOM company. So we went into products just to differentiate ourselves. So I was there for 4 years. Unfortunately, the company did not scale up all that fast. So then I came back to investments because one of my friends, Ashish Kacholia, had started a PMS.
Right.
So I joined him in 2004.
And I suppose the PMS continues to this day, very successful one. So in a way, whilst the dot-com bubble had an influence on your life, so did the 2008 bubble. And you're one of the few people who'd managed to sell a business to Lehman Brothers. Others got sold by Lehman Brothers. You managed to sell a business to Lehman Brothers, but then they went through the unfortunate events of a decade ago. What was it like being part of the roller coaster of the 2007-8 bubble, going up and then seeing the other side of the bubble smashing as well?
So maybe it's my destiny, but I was called the bubble analyst because I was in software in 2000, and in 2007 I was doing real estate. Fantastic. so I've seen very weird cycles happen, right? So yeah, I mean, I was covering DLF, Unitech around that time. Actually, in that crash, just before that, I had in fact wanted to go back to the document management startup we had because that got a round of funding around 2007. So for 1.5 years, again, I went back to that startup.
Remarkable. Remarkable. So the startup continues to this day?
Yeah, they're doing pretty well actually.
And you're still a shareholder?
Yep.
Fabulous. I had no idea about this, the entrepreneurial streak in Manish Gunwani. But that leads me to the aspect of your career which is interested me, fascinated me the most. You've consistently had the desire and the ability to spot turning points in the cycle, whether they be around economic growth, interest rates, currency. Is this something you've consciously cultivated over time? How did this analytical ability to time cycles and position your portfolio accordingly? Where did this come from?
So first of all, you're being very kind. It's not easy to spot these turning points, but I think, as I said, my experience has been in fairly sharp cycles. So whether it's the tech boom of late 90s or the real estate boom of 2006-7, and I think what I think is very important is to keep expanding your circle of competence. So I'll just give you a context. So when I was with Ashish Kachulia, for example, we were doing mid caps. Mid caps were really small at that point, 2004. So at that point, Marigo and Blue Dart were trading at 12 times P, and I remember discussing it was too much, paying 10 or 12 times for Marigo.
This is 2004-5?
3-4 types. So the point is, then we would go, and the entire investment process had nothing to do with macro. I mean, we would read about inflation the day after in newspapers and probably not pay any attention to that, right? So when 2008 happened, I got a lot of interest in macro because there's no way you could have got 2008 crash without macro.
Some macro insight.
Yeah. Because at the bottom, earnings growth was there, 2025. You could say PE was high, but it was not obnoxious of 50, it was 22, 23, right?
That's right, yeah.
If earnings are going 26%, maybe it's not that bad. But then I did go through that whole process of understanding macro. And I think then you read people like Howard Marks, etc. So then you start appreciating the whole thing about cycles, because you've seen industrials trade at 100p, trade at 10p. You've seen software services companies trade 100p, go back to 12p.
So given the emphasis that you place on turning points, what are the 2 or 3 metrics that you would use to either time the sector or the macro cycle as a whole? 2 or 3 favorite metrics.
So Saurabh, after doing whatever work I've done in micro, I think a good thumb rule for me has been that when you look at a country, I think there are broadly only 3 output variables of the economy which matter.
Okay.
Which is current account deficit, inflation, and growth. So the first 2 are actually checks on macro imbalances.
Okay, yeah.
So obviously it's like the blood pressure and heart rate of the patient. Now, what causes it? To my understanding, it's very difficult to go deeper than that, because the economy is such a complex black box that whether fiscal deficit is causing inflation, female labor participation is causing inflation, technology is causing, who knows?
Yeah.
So I've really stopped bothering too much about that. The point is, if inflation and CAD are under control, then you look at growth as a capacity utilization variable. Right. So if unemployment is very low, I think you have to be very careful about investing. So you have to be a bit contra on growth, I think, because things do tend to mean reward.
So things like interest rates, capacity utilization, those are not, you're saying, as central to your sort of diagnostics as...
So whatever growth, those are the 3-4 variables which come under that growth dimension. So the first 2 are kind of filters. I mean, if CAD and inflation are out of control, just leave it.
So tell me something, if you were to sort of just apply this framework, CAD, inflation and growth, is this what helped you figure out in late 2017 that small and mid caps, the rally is overdone and there's going to be a rotation out of small and mid caps? Because you were very emphatic. I think when I thought late 2017 that people are just going bonkers about small and mid caps, I was one of the few people who was thinking like that, and I saw your interviews and you were saying pretty emphatically that rotate away. What led you to make that very early call against small?
Actually, it's not so much the macro framework here, because to be honest, India has been fairly stable on the macro side in 2017. I think I also have this theory about dollar.
Okay.
So whenever dollar goes down, EMs do well and India does well. And it did look to me that obviously the valuations were frothy, but the dollar had come from 103 to 88. And usually nothing falls in a straight line. So you always feel that since Trump's victory when dollar was 103, which was end of 2016, to 2017 and end, it had reached about 88. Now, a 12 to 14% kind of fall in the reserve currency, usually you would expect a pullback at some point. But also, I have this funda that you can do macro, you can do whatever, but valuation actually is the starting point. Because see, macros are not very easily predictable. So if oil will go up $20, oil will go down $20, India's macro will change. So I think, and I think there's some empirical evidence to that as well, that um, stock markets, the biggest correlation is to valuation and not to interest rates, GDP growth, etc.
Fair point. And when you talk about valuation, your favorite valuation metrics would be PE, PB?
I don't think very simplistic structures work, because obviously in a cyclical, PE will not work. Sometimes you have to do a profit pool analysis. So it all depends. I mean, so one of our better investments in iPro was in general insurance. And it was not like these companies were very cheap or very visible. But the point was, if you just looked at any developed economy and see the size of the general insurance industry there, you could figure out that these companies will become very big. And what was happening was, due to some regulation on third-party pool and all, initially all these companies were loss-making, because the tariffs were there and all that. But you could figure out that once that effect goes off, because ADA had started liberalizing those regulations, that these companies could become very big. So sometimes it's not just P of 1 year forward. I think it's good to have a long-term profit pool analysis of that sector. And if a company has X market share, and then you see if that profit pool 10 years later is Y, X percentage of that Y, if it's big enough, then you probably are okay paying a higher valuation.
I remember Naren telling me that one of the ways you guys got the 2007-8 cycle right was the market cap of DLF was more than the pharma sector in its entirety.
Yeah, I was not there, but yeah.
Right. So I think this profit pool and the market cap pool, in a way, you're giving us fairly interesting metrics to time a sector beyond PE, PB, and the usual stuff. That brings me to another subject where you've sort of said something publicly which I found very intriguing. So I think it was an interview last year. You were saying that contrarian investing is as much about psychology as it is about economics. Now, unfortunately or fortunately, most for rest of us, we can read as many books on economics and valuation and accounting, but there are very few good books on investing psychology. How have you gone through your journey of getting your head around the psychology of investing?
Actually, I worked with Naren, and he's actually, I think, a great behavioral investing person. And so clearly a lot of that learning came when I was in iPro. So I think clearly, again, if you read authors like Howard Marks as well, I think you can do linear investing in the sense that good companies at reasonable prices, and you can achieve a certain amount of excellence. But that good to great, I think, happens with catching these cycles, because clearly there'll be a set of companies, and you've written a lot about it, about where you can just compound earnings. And you can be a bit disciplined about valuation, not overpaying for them, and make decent returns. But clearly,
the exception
about shorting tech in 2000, shorting infra in 2007, buying FMCG, ID Pharma early 2000s. I think that you need a perspective on the cycle. And I think, as Charlie Munger says, multiple disciplines go into that. So your macro goes into that. I think reading economic history goes a lot into that.
I think interesting that you mentioned it, because I think one of the less appreciated facts of Warren Buffett's career has been, and especially in his prime, his ability to get the cycle right. So when you read Buffett's career, 66, 67, through the 50s, through the 60s, loading up on American stocks, 67, I think at the height of the boom, getting rid of them, 73, 74, the market troughing out, picking up stocks, mid 80s, picking up stocks, and then that being the driver of his wealth. So it's just that it's very hard to do this, right?
And if you read about Buffett as well, so he's played at the silver cycle. He's bought Goldman in 2009, which are not traditional GARP investing.
Now that you mention it, if you look at Warren Buffett, almost his only successful financial services investments have been the ones that he's bought in stressed circumstances, right? Goldman being the most memorable one, which in turn, I suppose, reminds us that if those who are buying banks and NBFCs at 4, 5, 6, 7, 8 times price to book today, maybe they've got some other mental framework of investing which is not known to most of us. But let's sort of move on to the subject of influences. Clearly, Naren's been an influence. Who else beyond Naren? From the sounds of Ashish Kacholia has been an influence. Who else has sort of influenced the way you've seen the world and you've taught yourself this trade?
So clearly, when I started my journey in sell side, Ashish Kacholia was my boss in Prime Securities. So obviously, I've worked with him as well. Right. So he's been very influential. He's more of the GARP kind of investor. The friends like I have a friend called Kaushik Shekhar, for example, who's a vigor in accounting and thinking about business models. Clearly, that has obviously been a big influence as well.
So Naren's indoctrinated many of us over the years that the three gurus that one should look up to is Marx, Mabusson and Monty, or the three M's, I think, as he calls it. Are you two worshipping at their altar?
So Saurabh, what's happened with this digital thing, the reading gets more diffuse. Right. So I've read Marx and Mabusson, I have a lot of respect. I think recently Victor Schwetz in Macquarie, I think his writing is very interesting. Very interesting. Plus, you have a lot of these strategists globally, but it's much more diffused. I don't think I can remember one or two names who I intensely like or dislike.
Right. So Victor Schwetz in Macquarie. Sorry, any other suggestions as to other sources of intellectual enlightenment that we can look forward to?
So I think Credit Suisse global strategist Gathwate, I think he's very interesting. I think Morgan Stanley, the economist team, I think their team is good as well.
Fantastic. So let's move on to another facet of your investing. You've spoken repeatedly about how much you've invested in your own funds in your previous avatar. Is that something that came because you felt comfortable putting money in your own funds, or is that something you feel ideologically that a fund manager should really eat his or her own cooking?
I think at some point it's good to have a fair percentage of your net worth in your own funds. I think at a seniority level, I would like to see that. Now, clearly, when you're young and you're starting out and growing up the ranks, that's not so important because you obviously need to buy a house and all that. But I think if you follow people like Seth Klarman, I mean, almost their entire saving is in their own funds. And I think that's something that is good to see.
So you see, this is Bauerpost's case. Yeah. A lot of the savings is there. And do you think that practice is as common in our country as it is in promoter-driven shops in the West?
To be honest, I don't know.
Right.
I've seen the data.
Yeah, because you're one of the few people I've heard who are very vocal on this subject. And whilst a lot of the US endowment funds and pension funds insist that fund managers do it, I don't think in the mutual fund community or in the Indian investor community, I
think our industry is still in a nascent stage. I think as people manage largest amounts of money, and obviously you reach a point where your balance sheet is okay, then I think incrementally your savings going into your own funds is a nice thing to do.
Right. And then moving away from the world of investing, I've heard from your colleagues that you're a keen sportsman who plays multiple sports with equal equal sort of
You're
facility.
being kind again.
And some of your college mates have also commented on your sporting prowess. So, from the world of sport or entertainment, any role models, any idols that you look up to?
Actually, I play jack of all trades,
Right.
badminton, cricket, but I somehow don't watch too much of sports.
Right.
So if you ask me, my role model, they go back to very long time when I used to watch a lot of sports.
Right.
So it was the likes of Steffi Graf.
Right.
Those posters there in my hostel room.
So I think there's plenty of us who go back a long time. So she clearly was a formidable sportswoman, and she married another formidable sportswoman. But I suppose the enduring image that I have of Graf's career is that Grand Slam. I think the one
Golden Grand Slam.
the Olympic gold and the Grand Slams. I don't think that'll be emulated. It's remarkably rare, right? Because you got to do it once in that Olympic year. So I hope you have a equally successful career. Thank you very much for your words of wisdom today. That was very interesting. That's it from us today. That's it from Manish Gunwani, CIO of Equity Assets at Reliance Mutual Fund.